Welcome to the fourth lesson of the Free Academy. This lesson is all about risk management, and one thing you need to understand is that your job as a trader is to manage risk, not to make money. It's primarily not to lose the capital you have. You need to protect that at all costs. So let's dive into the module. So risk management starts with three things. You do have an entry, you have a stop loss, and you have a take profit. So the thing is, the entry is the place where you place the trade, so where you want to execute an order. Let's say Bitcoin is trending, or Bitcoin is currently ranging at between 41 and 42,000, and I want to buy at 41,900, just as right here in the example. That's where I place my order. My entries are almost always placed with limit orders. Why is this? Whenever you place a trade with a limit order, you will get filled and not pay a fee. Like the fee is almost 0%, and if you're trading stocks, it's a fixed number for limit orders. However, on the other hand, whenever you're trying to get in a position with a market order, the fee will be significantly higher. So that's your entry. Then you have a stop loss and you have a take profit. So the first of these two cannot be forgotten. You do have a stop loss, and this needs to be placed always. It's not favorable, but you can sometimes forget to place a take profit. That can happen, but you can never forget to place your stop loss. Why? Because your stop loss is the place where you will get out of your position if your plan invalidates. So that's basically where you place your stop loss. It's a non-negotiable thing. Never trade without any stop loss. It's 100% certain that you need to have a stop loss to become a profitable trader. So whenever you have placed that stop loss at the right point, you will need to place a take profit as well, because if the trade moves in your desired direction, you want to get out of that position. You want to take your profits and see whenever you can scale in or take any other trade. All these things, so both the stop loss and the take profit, are actually set before you enter the trade. So you place a trade, and in your mind, you already have the points like, hey, at that point I want to sell, at that point I want to take my loss. So basically that's it. And what you can see right here is no plan means no trade. And it's every single time it's the exact same thing. Whenever I don't have a plan for my entry, take profit, and stop loss, I cannot take any trade. So once again, you firstly place your entry, then you place your stop loss and your take profit. And this goes all before you are in the position. I hope you guys understand this, because it's a very essential part of trading. So let's move on to the next slide, which explains to you that you can only take about 1 to 2% risk per trade. What does this mean? If you have a $100 account, you can only lose $1 per trade at max. If you have a $1,000 account, you can lose $10. If you have a $10,000 account, you can lose about $100 per trade. This is something you need to understand correctly. Why? Because if you have an account size of 10K and you are losing $5,000 per trade, then you can essentially take 2 trades and then your account is gone if the trade goes wrong. And what you need to understand is that if you only risk about 1 to 2% per trade, even with 10 losses in a row, you only lose about 10 to 15% of your total account. And your account survives, and you can learn with that same account size. So no single trade could cause your account to be down 40 or 50%. It's just not possible. And if you ignore this rule, so if you want to trade with 10% risk per trade, I can guarantee you that you will move your stop loss out of emotion, because you're not certain that your trade is going well, because you can never be certain. No one has seen the future, and you can never be certain as it is going to move up or down. So if you take 10% risk per trade, on a $10,000 account, it's $1,000 risk per trade. But if you say hey, no, I think the price really is about to move in my desired direction, I will just move my stop loss a little further down or anything like that. That emotional panic causes very, very big losses to appear in your account, and that's not what you want. So The most blown accounts that traders have is because of oversized positions, because they took way too much risk. So, how to size correctly? Basically, you are having your account size, you take a 1% risk. This is the maximum risk amount you take per trade. The dollars of risk you need to divide by your entry minus your stop loss, and this would essentially give you your contract size. If you use journal trades for all this, it's calculated automatically whenever you put in a trade. So that's basically the 1 to 2% rule. I hope you understand this. Never risk more than 1 to 2% of your account size. So then you get to leverage, and this is once again, it's a tool that needs to be used correctly and with the right mindset. It's not a shortcut to get rich quick, guys. There is no such thing. So leverage lets you control a larger position than your actual capital. But, and very important note, it multiplies both the gains and the losses by the same factor. So whenever you use it responsibly, you can control a large position with less tied up capital because you can use leverage. So you can have a larger position, like a $10,000 account with a 10x leverage. You would essentially have $100,000 in a trade. Understanding that whenever the price on a $100,000 position moves down 1%, or 2%, or 3%, or 4%, you will lose up to $4,000, if you understand what I mean. So you can use your leverage responsibly and let it amplify your gains on high conviction plays. So this is completely possible, but what you need to understand is that you need to stick to that rule of 1 to 2% at max. So professional users, or professional traders basically, use leverage with strict position rules. So what this means is you always risk the same on a trade, and if you need leverage, you need leverage. If you don't, you don't. That's basically how simple it could be. So what you need to understand is that if you're trading with a low leverage, so 2x to 5x, it's manageable. You can do it with discipline, and the chances of you misusing it just are getting very slim. If you are misusing your leverage, so you will take a 10x leverage, you will take a 10% loss, and you will blow your account within weeks, even days. So what I'm seeing very often is that new traders are constantly over leveraging their positions. Like they think this position is moving in my desired direction, so I'm going to use more leverage. But the downside is that you could also lose very much of your trading account. Just what I said, it amplifies the loss just as much as it amplifies the gain. And high leverage without any stop loss, because this is very often going wrong, or like moving the stop loss, is a 100% certainty to blow up your account. So bottom line, leverage does not reduce your risk. It only magnifies whatever risk you already have. So then moving to the last slide of this module is that you need to have a checklist pre-trade. So before you enter any trade, you need to go through a checklist. Before every single trade, you need to ask yourself these questions. Where exactly is my stop loss? What is my risk in euros and dollar? What is my risk in a percentage? What is my take profit target? And does this setup fit my trading plan? So basically, you need to have a trading plan. You need to have a clear state of mind that you can think, hey, this is where I want to get in my position. This is where I want to get out of my position. So firstly, set a stop loss and never move it. If you have placed a stop loss at a certain point, that's where your plan invalidates. So that's the point where you place your stop loss. The other thing is that your risk must stay within the 1 to 2% of your total account. So if you see you are taking $500 risk on a $10,000 account, it means you are over leveraging your position. You are taking way too many risks percentage-wise. So the next thing is that you need to see that your profit target is a R multiple of 2 or higher. What this means is that for every percent, so for every dollar you risk, you essentially make 2 if you win the trade. So if you lose 1. If you win, you win 2. So basically that's the bare minimum for any trade. And does this setup fit my trading plan? It speaks for itself. If the setup doesn't fit your trading plan that you have built, then you cannot take the trade at all. So I hope this makes some things clear to you, because risk management is, I can guarantee you, the most important thing within trading, because we are, as traders, just risk managers. We are not trying to make as much money as we can. Like eventually you will, but primarily if you're beginning, you want to focus at not losing all your capital at once. So this was it for this lesson. And in the next lesson, we will talk about actual price action and the things you need to get started with learning whenever you want to get started with trading. So that's the lesson you all have been waiting for. So I'll see you in the next lesson.